Hello and welcome to Chapter 5, where we're going to be looking at recognizing the flow of costs through job order costing systems. That is also calculating the predetermined overhead rates. On the screen, I have a picture of what a physical job cost sheet would look like kind of back in the day, because now it would be manual, it would be digital. However, this job cost sheet is a form that is prepared for each separate job that records the direct materials, direct labor, and overhead charged to the job. So you can think of this like a physical piece of paper, but nowadays it'd be just like electronic, but you can kind of see in here, we have the DM, DL, manufacturing overhead, what is in here and how much. So it's like a tracking sheet, a job tracking sheet. Okay, so just to help you visualize that this is kind of like what we're doing, and there'd be one of these for each job. All right, so our direct materials that go into our job, each one of the sheets. So look at this as each one of the sheets. That's sheet 1, sheet 2, sheet 3. All right, so we're going to start off with direct materials. There would be a materials requisition form in a document that specifies the type and quantity of materials to be withdrawn from the storage room and placed onto each job directly. Each one of those requisition forms identifies the job to which the costs of the materials are to be charged. So our black arrow here. The form then controls the flow of materials into production and also makes entries into the accounting records, which we'll see in just a little bit. Similarly, our direct labor is labor costs that are handled similarly to direct materials, except they typically are used and allocated by computer system time tickets. So an employee would likely track their time, allocate it to a job in that timesheet, and the timesheet would then be applied to each one of the jobs here. Only direct labor costs get posted to the job sheet, whereas indirect labor is part of manufacturing overhead and does not get directly posted to the job sheet, but rather becomes a bucket of costs that then gets allocated to each one of the jobs. So let's take a look at that now. Manufacturing overhead, whereas our indirect costs, so indirect materials, indirect labor, items such as supervisor salary, items such as manufacturing plant rent, manufacturing plant utilities, property taxes, depreciation from manufacturing equipment, and so on. So all of that goes into our MOH, our manufacturing overhead bucket, and then gets applied out to each of the jobs. We use an allocation base such as direct labor dollars, direct labor hours, machine hours, or perhaps something like square footage of the plant to allocate manufacturing overhead to individual jobs. An allocation base is used because for a number of reasons. It's impossible or difficult to trace overhead costs to a specific job. Manufacturing overhead consists of many different items, ranging from the grease used in machines to production manager salaries, so just like a lot of things to keep track of. Many different types of manufacturing overhead costs are fixed, and therefore the output fluctuates throughout the period. So how you're going to allocate fixed costs, as well as the timing of the payment of manufacturing overhead often varies. And it's not like you can tell your utility company, oh no, don't bill me then, I haven't finished this job. So all of those costs are just like, they're difficult, they're messy, there's a lot of them, there's like just incomplete timing. We throw them in a bucket and we find a reasonable allocation base to allocate their fair share to each job. So we have a number of different ways in which we do this. So the process is kind of twofold. First, we determine our predetermined overhead rates, our POHR, and then we find our overhead applied. So this is kind of like our best guess of what overhead we're going to apply to each job throughout the month. So we find our predetermined overhead rate, plug it in there, and then we get our overhead applied. So we use the predetermined overhead rate because, and it's determined before the period begins. The reason that we use this POHR is because using a predetermined rate makes it possible to estimate total job cost sooner. We need to know total job cost sooner so that we know what to charge customers. We need to know, are we making money on this job? We need to have some sort of relatively accurate and, most importantly, timely information. That's because actual overhead for the period is not known until the end of the period, and oftentimes isn't known until after the end of the period. You get your electricity bill after you've used it. You tend to pay salaries like a week or two after they've been incurred. So we use the predetermined rate, and it's based on estimates rather than actual costs. This predetermined overhead rate is computed before the period begins, and we use it to apply overhead costs throughout the period. So ideally, the overhead allocation base that we use, because the top is all of our costs, the estimated cost, the bottom is the total estimated number of units. Ideally, this allocation base is a cost driver that causes these overhead costs. The cost driver is a factor that causes the overhead costs to occur. If the base does not drive costs, then the overall predetermined overhead rate is not going to be accurate. A common allocation base that is used tends to be direct labor. All right, so we take the total estimated number of manufacturing overhead costs, divide it by the estimated total units in the allocation base. This is done before the beginning of the month or beginning of the year, and this becomes our predetermined overhead rate. Then we take our rate, and as the activity occurs throughout the month, the year, then we times it by the actual activity. So previously I said that direct labor was a common rate. Well, then we take our predetermined overhead rate. We see that our job requires, say, 10 hours of direct labor. So we take POHR times by 10, and we apply that overhead to that job. So if we look at another example where we've estimated that we're going to have total manufacturing overhead costs of $320,000, that would mean, and we estimate a total of 40,000 direct labor hours, that means our predetermined overhead rate would be $8 per hour. Oops, sorry. And then if we had, say, for example, 27 direct labor hours charged to job 24567, then what would our total number of overhead applied to that job be? So take a moment and think about it. I'll put some numbers on the screen. So if we had predetermined overhead rate of $8 per hour, and we had 27 direct labor hours used, right, like we just set up there, then our overhead that we would apply would equal 27 times 8, and that would be $216 that we would apply to job number 24567. All right, let's look at a flow of how all of these costs work. So to wrap it up, right before a quick check, we would have a sales order, and the sales order would be like the salesperson saying, hey, we're going to create this architecture job, for example. Then production is like, okay, great, working with the architect. Maybe it's an architect and their 2 apprentices, and maybe they're also doing a mock-up, perhaps that includes several different types of materials. So then they would get a materials requisition form, figure out all the materials that are going to go towards planning of this architecture job. They would have each member of the team allocate their time, the hours spent, and then they would apply perhaps at the end, say, okay, well, we had 50 direct labor hours times by our direct our predetermined overhead rate. So then we would take those direct labor hours earned here times by the predetermined overhead rate. And each one of these items, the direct materials, direct labor, and overhead, would go to the job sheet. And then that is used to see how much is the work in the work in progress for that job. When the job is finished, then the job becomes a cost of good sold in an architecture company. If this was, say, something like a custom built house, and it wasn't, maybe we're doing it for spec, then it would go to inventory. So it would be going from work in progress to inventory, so via cost of goods manufactured. And then once sold, it would go from the ending inventory to the cost of goods sold. So understanding and really integrating, leveraging what we learned in chapter 1, chapter 2, we're really getting to kind of see, okay, how is this applied to job order costing here? There may be some instances where chapter 3, so understanding relevant and non-relevant costs, factor in. So yeah, something to keep in mind. All right, let's take a look at a quick check. So please consider pausing this, attempting it, and then I'll see you after you unpause it to see how you did. Cheers. All right, welcome back. So we're trying to see what would be recorded for job WR53. So we know we're going to have some direct materials. Come on, type. Direct labor, and then we're going to have some manufacturing overhead, and this will be our total cost for this job. So we need $200 of direct material. Cool. $10, 10 direct labor hours at $25 per hour. So equals 25 times 10. Fabulous. Okay, manufacturing overhead. All right. Sounds like I might have to find out my predetermined overhead rate. And so that would be my total costs divided by the estimate of hours. So they estimated total overhead for the year to be 760,000 divided by the total direct labor hours anticipated for the year, 20,000. So then I have a predetermined overhead rate of $38 per direct labor hour. Cool. All right, so then my manufacturing overhead, oh yeah, I incurred 10 direct labor hours equals 10 times my predetermined overhead rate of 38, and that gets me 380. So now I need to add up these three costs, and I get a total cost for this job of $830. So if you picked D, you would be correct. Alrighty. Well, thank you so much. I will see you in the next video. Cheers.